Hello, my name is Mel Holsworth and welcome to this presentation for Self-Managed Superannuation Fund Trustees for the year ended 30th of June 2012. In this presentation I'll be dealing with the timing and reserving issues of contributions. I'll have other presentations for contributions covering not only timing and reserving, which this is the beginning of that presentation, but also dealing with concessional contributions, non-concessional contributions, contributions in kind, payment of self-managed super fund expenses, out-of-pocket expenses, and of course the new 30% contributions tax for those earning notionally over $300,000 a year, and a little bit on government co-contributions. So let's look at the first topic, dealing with contributions and reserving, most specifically dealing with timing. We're assuming, of course, that contributions are deductible, and there are 3 or 4 criteria that need to be met. So the assumption is there that the contributions being made are being sought as a tax deduction. Now, the first point we need to make is that superannuation contributions are counted in the super fund when they are received, not when they're paid by the payer. There's no such thing anymore as creating a contributions receivable account. In other words, trying to match up the payer's accounts to the super fund's accounts. No, contributions are counted to the fund when they're banked or when they're received, or when expenses are paid on their behalf. If you want to capture a contribution in a specific financial year, then you must time the payment correctly. If you want to claim a tax deduction for the contribution, then it is claimed when it is cleared from your bank account and not when it's received by the fund. And that's important an important point for this financial year, because the 30th of June is in fact on a Saturday, which bankers don't transact on that day. And so if you want to capture the 2012 contribution for tax deductibility, or if you want to receive it into the superannuation fund for this financial year, then the very last day that contribution should be made would be the 27th of June, allowing 2 days being up to the Friday the 29th for it to be received in the superannuation fund. So just bear that one in mind. It's a timing issue for this financial year, because the 30th of June is in fact on a Saturday. Of course, we have been used to using contribution reserves in the past, and this is no different again. What are contributions reserved? Well, essentially we have 2 ways that when a contribution is received into a superannuation fund, there are 2 ways that they can be counted. Firstly is the contribution can automatically be allocated as at that date to the member account, or it can be allocated to a contribution reserve account and then at a later date taken out of that reserve account and put to the member account. Now, if you want to use reserving, of course the trustee must allow it. The legislation, the SIS legislation, regulations and the ATO all allow reserving, but of course they may allow it, and if your trustee doesn't allow it, then we can't use reserving. Now, reserving must be consistent throughout the year, so if you're going to use contribution reserves to receive contributions and then allocate them to a member at a later date, it must be consistent throughout the whole year, not just for one contribution during the year. So let me give an example how reserving works. Let's just say I'm 53, which is what I am. Each month I've contributed contributions of $4,200. And then in June I contribute another $10,000, so the total for the year is $60,400. My concessional contribution cap for the year ended 3rd of June 2012 is in fact $50,000. So in fact I'm $10,400 over the cap. Do I have a remedy, or do I have to pay excess contributions tax? Well, yes, I do have a remedy. If I allocate my $4,200 each month, instead of going directly to my member account but putting it into my reserve account, contributions reserve account, it then allows me at the end of the year to take that excess of $10,400 in June and put it in the reserve account. Now the rules of the reserve account are these. Simply put, the reserve account must be cleared to the member's account no later than 28 days of the following month. So if I put that extra $10,000 plus also the $4,200 that went into my super fund in June, so in actual fact my June contributions show $14,200, of which $10,400 are excess contributions. I can clear out of that reserve account what I need to for that financial year to bring my max tax concessional cap up to $50,000, and the other $10,400 I'll leave in the reserve account on the 30th of June and clear it out of that reserve account in the next financial year, being in July, and I have to do that before the 28th of July. Now, of course, that's all done by Heather here internally, and it's done by way of journal entry, but it's something that we need to do in order to get around excess contributions tax being paid in that financial year. Now, of course, if you use reserving and the contributions made exceed $50,000 in this current financial year and $50,000 in the next financial year, then okay, you're going to cop excess contributions tax in the next financial year when it comes out. So it's important, if we're going to use contribution reserves, that minutes are done, and Heather will guide you there, and maybe even do the minutes up and send them to you for signing. Remember that reserving has no implication to the treatment of the tax deductibility of that contribution to the payer. So in fact the payer may be making excess contributions and claiming them as a tax deduction, and through this reserving side of things in the self-managed super fund, we're able to avoid excess contributions by using the reserve account. So it is possible to stack up contributions in one financial year and part of that to roll over into the next financial year, and so long as between the 2 years you don't average or you don't exceed the $50,000 in my case, because I'm over the age of 50, $50,000 for year into 30th of June 2012, and of course in 2013 the $15,000 has reduced to $25,000, and there's more on that later. So provided that between the 2 years I don't exceed $75,000, then I won't have any problems. Now be careful that if you reserve your June contributions, remember that whatever's put in that reserve is actually going into the superannuation fund accounts as contributions in the following financial year. So in that financial year, you already are starting with contributions into the fund. So we need to be careful that we don't make excess contributions in the following year, or if we do, we're going to do the same reserving again in June and throwing into the next year where we can. It's a common mistake for people to forget that they've got reserving and they're already starting the year with those financial accounts. Well, that's the end of this presentation. Thank you very much for listening.